Hey everybody, this is Jim at SP500chart.com. It's Sunday early evening, about 6:15 on August 9th, 2015, and we're going to take a look at what happened last week. See if damage was done to our potential bullish pattern, and see what happened on Friday, what happened in the past week. Before we take a look, as always, I need to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look. Well, starting out now on a 30-minute chart. And just a reminder, a 30-minute chart means each candle that we look at on this chart represents 30 minutes of trading. And you can see that over the past 6 days or so, it appeared that we were in a sort of a descending wedge right here. And we sort of identified that before we had this move above this upper resistance line on Wednesday. But I think what happened, and we'll see if this bears out this week, I think what happened was we just got ahead of ourselves, that we had what a technician might call a premature breakout or a false breakout. Because what happened after we got up to over this resistance line, we came back down to it, paid a little tribute to that on Thursday, but then we fell back down, hit our support line again, rallied back up to the old resistance line. Remember, this breakout right here never was a breakout because it was not by a large margin. The height of the trading was about 21.12, and at that point we were up about 17 points. That's not a percent. So we fell back down to the pattern, came back to the resistance line, then on Friday actually traded underneath our support line here, which was a little interesting to see that happen. But if you think in terms of the fact that a premature breakout would create an excess of selling pressure once you get back into that pattern, maybe that's why that happened. Again, if you think of the tug of bull against bear, if you look at it like it's like there's inertia involved, this was a move out of range prematurely. And then when we started to come back down, it's going to have, in all likelihood, an excess amount of selling that happens because there was an excessive amount of buying that did not adequately take us out of this pattern. So we ended the day on Friday and ended the week right at about our old resistance line. Now the question becomes, with that being the case, does that mean we expect the markets to start out with a weak Monday? Well, that's possible, and I'll be the first to say that anything is possible. But by virtue of the fact that we had a descending wedge pattern that I think is pretty clear. Again, this false breakout sort of clouds the picture a little bit, but I still think there is probably an upwards bias built into the last 6 or 7 days of trading, despite the fact that it felt kind of ragged and fairly rough, having gone from the highs on Wednesday of 21.12 to the lows on Friday of the upper 2060s. So we're looking at a loss of about 45. No, not 45. Let me do my math real quick. Hold on. Yeah, I was right, about 45 points. So about a 2% swing from the week's high to the week's low. So I would look for this line right here, look to this line as a sign of what may be taking place if we get over that line again. Additionally, if we want to zoom in just a little bit, we can even do so on a 10-minute chart. If we look at the last 3 days, do we have any trend lines that help us out here? Well, if you look, we've got 1, 2, 3 touches on a support line. And now let's see if anything lines up worth 2 cents with respect to resistance. Well, guys, it sort of looks like, with the exception of this little opening move right here, it sort of looks like we might be dealing with yet another wedge pattern. So that means we could be seeing a larger wedge, a false breakout, and then a smaller wedge. So all of that seems to indicate to me that that the S&P is probably very near a rally. Now, one thing that happened over the week that that is not particularly helpful to my case in calling for a rally is the fact that we traded underneath this support line right here. As a matter of fact, we ended Friday just touching this line after having broken through it just a little bit. How much is a little bit? Well, less than 0.5%. So I don't think we have yet, I don't think that the bears will have succeeded in turning this support line into resistance with just that little dip right there. So what I would do is I would look for a couple of things. I would look for any one of these 2 gray lines right here, particularly this one. If we get above this one, right, this one, tell you what, to make things easier to understand, we'll change the color of this larger descending wedge to red. So if we get clear and free of this upper red line, then I think we should be headed back to test some of our resistance lines that are above us. This blue line I'm not super concerned about because it is very, very long term and it has a lot of distance between its various touches. I know you're looking at this and you're saying, yeah, but we broke through it and then we back tested it. So yeah, it probably does have some influence. But if we go back here, you can see we got under it before and rallied back over it, and we did the same thing in early July. As we look on a daily chart, or even I think probably shows up better on an hourly, we got underneath it, rallied back, got underneath it, rallied back. Now we're underneath it by a little bit more, but still pretty close to, but not greater than 1%. So if we look at these little patterns, they seem to be adding up to say we are ready to rally. If we look at some of the longer term lines, that brings maybe a little confusion into the picture. Finally, one more thing to show you. Where we had our lows on Friday, if we back off here and you look at this area back here on the 28th, I'm going to snap that line again. What do you see? Well, you see where a gap from a short-term low, we gapped up on the 28th, sort of came back to fill that gap. And again, I want to remind you, I am not a big believer in gap filling. It does happen, but I think it just happens out of the course of normal trading. I don't think there's anything magical about gaps where they have to be filled. It just so happens most of them are. What I do believe in is gap support or gap resistance, depending on which way the gap formed. So we had a little gap on the 28th. The lows of Friday did fill that gap, and maybe we're starting to see some gap support right here. So watch this upper red line on Monday. We're already above this resistance line right here. If we get over this by a decent margin, then I would expect us to rally back to test this blue line and then these two gray lines up here. But the final goal in all of this, to remind you, is to get back up to this neckline level where if we do succeed in doing that, then we look at this chart as a serious potential as an inverted head and shoulders continuation pattern. Right now, I still think things are in place where we could be looking at this pattern, but the more time we spend not attacking this neckline and instead putting pressure on some of these previous lows that were set in the first part of July, then the less I begin to feel enthusiastic about this pattern. And it's only a matter of time before one of these patterns totally fails us. I hate to say that, but they do not all work out. They work out with amazing regularity. So far, we've seen probably better than 80% of them work out over the past 6 years. So that that tells me when you see this pattern and you trade based upon it, you have a much better than 50% chance of being right in your trade. So far, they've all been right over the past 6 years. If this one fails, it will be the first that really fails. Now, we had a smaller one back here in the first part of May. It did. So far, it failed too, but this is a much larger pattern. This one was fairly small, didn't carry a very large upside target. And if you look at where it was located as well, it just wasn't in quite as sweet a spot as what we're looking at right here. So, I am hoping that we get a continuation of the late day buying pressure that we saw on Friday for Monday, sufficient to bring us back up over our blue line and then to come back and attack this descending gray line. This one is not that important. So, we are currently technically under support, looking at the intermediate trend. But looking at the short term, it looks like we may be putting some pressure on this line to start with on Monday. So I'm kind of in a wait-see attitude. Don't have a super strong feeling, but I would love to see a return to this neckline. And just to remind you, over here on the left side of this pattern, we had a double dip for the left shoulder. So a double dip may not be totally out of the question over here if we are in the process of forming a right shoulder. So not all is lost. Let's just see what happens on Monday. We'll do a video at the end of the trading on Monday, and we'll analyze it further at that point. Finally, one more thing to remind you. We do have a support line underneath us here. This line broke out. We had a false breakout here. Sound familiar? Like we had a false breakout here. And then we got underneath this line again. Then we broke out and back tested. If we come back for a second back test, I think we've got a very good chance of seeing this line providing good support. If these two little descending wedges are nothing but noise on the chart there to throw us off. Hopefully not. Hopefully these are telling us the truth and we are ready to rally. So guys, there's your video for the week ending August 7th, 2015. Thank you for watching. Thank you for your support. Hey, if you are not a member of SP500chart.com, what are you waiting for? It's less than like a cheap cup of coffee per day to be a member and to see the Monday, Tuesday, Wednesday, and Thursday technical analysis videos. Now, albeit, I'll admit, the year 2015 has been a difficult year to get a handle on the chart because we've just been going sideways. We've been really stuck in a range since late February. And at some point, we got to break out of this. We cannot stay here forever. And it's either going to be up or it's going to be down. Right now, we have a decent pattern that looks to be forming, that if we get it back up to that neckline and then break out, then that should cement the next move as being an upwards move up into the 2220s. So, think about it. You can see technical analysis like this after every day's close, and think about how that might help you out. How much does it cost? Well, go to sp500chart.com and tell you. All I can say is less than a cheap cup of coffee per day. I'm not talking about Starbucks here. I'm talking about vending machine coffee. So go check it out. Thanks again. Take care.